CNR has been a cornerstone of the Canadian market, but recent challenges have raised a few questions. Are they still the powerhouse they once were, or are cracks starting to show? Fasten your seatbelts, folks. This is going to be a good one. Canadian National Railway, with that ticker of CNR, is an iconic investment that plays a vital role in Canada's economy. With their unique position in the market, they have been often considered a defensive go to stock for sure. However, with recent struggles and increasing competition from CP, we have to wonder if CNR is still the same old reliable investment they've always been. Are they still that go to stock for defensive investing? CNR is one of North America's largest rail networks, spanning coast to coast in Canada and, well, stretching deep into the United States. In fact, they do touch the Gulf of Mexico. Their extensive reach allows them to transport everything from raw materials to finished goods, effectively acting as the backbone of North American trade. They have some huge advantages that have kept them at the top of the heap for a very long time. I did mention size. Well, that massive rail infrastructure includes more than 20,000 miles of rail, which makes them the third largest rail network in North America. For comparison, CP is actually pretty darn close. They're coming in at fourth, and they basically have about 400 miles less track than CNR, especially after their merger with Kansas City Southern. CNR also caters to a lot of diverse cargo from agriculture and chemicals to mining materials and consumer goods. They have access to the Canadian North and are, in most cases, the only option for moving materials from a lot of those mining operations. In addition to those advantages, this is a company with a huge economic moat. Rail transportation is highly cost effective for bulk goods, and the barrier to entry for competitors is beyond enormous. When it comes to disadvantages, they do have their fair share, including weather dependency, labor relations, which we saw a fair amount of in 2024, and future environmental concerns. Why do we consider CNR to be a defensive stock? Well, their consistent demand and diversification make it a go to choice for investors seeking stability. Regardless of economic cycles, goods need to move, and CNR's expansive network ensures they're always in the game. Their long term contracts and high operating margins also provide a steady revenue stream even during the downturns. I am often asked which stock is better, CNR or CP. While CP has its strengths, CNR's slightly larger network and more diversified cargo give them the edge for defensive investors. CP's focus on certain high growth markets may offer greater upside in the good times, but CNR's broader approach offers more resilience in uncertain times for sure. A sub to the channel keeps you on track for more future content. The data for today's deep dive is coming from their 2024 Q3 quarterly report, which was released last October. As usual, I read through that report and have come back with a few highlights for you. They reported a 3% increase in revenues compared to the same quarter last year, with revenues reaching 4.1 billion. This sure does demonstrate consistent financial growth. Despite challenges such as wildfires and labor disruptions, the company showcased its ability to recover quickly and maintain efficient operations, reflecting some strong adaptability and management. Finally, their diluted earnings per share rose by 2% to $1.72, signaling steady profitability and value creation for shareholders. That is all fine and dandy, but if we want to get the real lowdown on CNR, we're going to have to hit those fundamentals. With numbers involved, we need to call on the conductor of calculus, the engineer of equations, the one and only Mr. Math. We will start off with a little bit of their surface data. At the time of recording, their current value is coming in at $148.39, and they have a market cap of 93.31 billion, and their beta coming in at 0.65. So right away, we can see they are less volatile than the market average, which would be 1.0. Their earnings per share, 8.45, and they've got a price to earnings ratio of 17.56. We are not going to look at an average, as we only have one Canadian pair being CP, who has a PE ratio, by the way, of 29.23. Their price to book ratio, 4.79. They have a return on equity of 27.55%. That is not too shabby at all. Their return on assets come in at 8.18%. Overall, these do look pretty darn good. And you guys know I love a good return on equity value for sure. Okay, let's peel back a layer and take a look at their cash situation. They have a revenue of $17.16 billion per year, and their earnings are coming in at 5.43 billion. Those projected earnings, they are forecast to grow by 4.17% per year over the next 5 years. Their profit margin, and I do like this number, 31.7%. Free cash flow, 3.58 billion, and that operating cash flow, 7.12 billion. Okay, let's take a look at their fair value. So their current value, $148.25. Using a discounted cash flow model, we do get a fair value of $148.69. So that does show them as being undervalued by 0.30%. Looking though at their 1-year target, that's coming in at $171.57. So they are expected to grow by 15.7% over the next year. That would be fantastic. With CNR being down right now, I actually do think that is an easy target for sure. Their cash data overall is pretty solid, and I do feel they should have a much better 2025 compared to 2024. Okay, let's turn the page and dive into their return data. When it comes to dividends, they have a yield of 2.28%. It is a quarterly dividend of 84.5 cents per share. The payout ratio on that, 39.35%. If we look at their 5-year average dividend increase, that does come in at 9.31%. I will add that CNR is a dividend aristocrat with a 29-year consecutive record of raising their dividend. That's actually the 10th longest streak currently in Canada. Switching to returns, on their 3-year return on investment, that does come in the negative 2.46%. Add in the dividends, we get a total return of 3.77%. Switching to their 1 year, now they had a rough year, guys. That return on investment, negative 10.64%. Total return after we add the dividends, negative 8.60%. These numbers are very low for CNR as they had a rough year with lots of labor issues as well as disruptions from those wildfires. When we look at their 3-year annualized return, that does come in the positive 1.24%. As I mentioned a moment ago, these numbers are lower than we are used to seeing with CNR. I do expect better data in the coming year. Okay, let's take that final leap and dive into their debt data. They have a total debt of 20.69 billion and their total equity coming in at 19.46 billion. This is a debt to equity ratio of 106.3%. I will point out that debt to equity ratio has increased from 73.2% over the last 5 years. So, yeah, their debt is heading in the wrong direction. When we look at their cash and cash equivalents, it's not that great, 273 million, so not a lot of help there. Looking at their short term, they have assets of 3.04 billion, liabilities 4.72 billion. I would love to see those numbers flipped. All right, looking at that long term, they have assets of 51.44 billion and liabilities of 30.30 billion. That's more like it. That's more like it for sure. Overall, their debt situation, it's not ideal, but at the same time, it is still well within their control. They do have the cash flow to cover the debt as well as the interest payments on their debt. With rates coming down, that is only going to get better. If we look at share dilution, there has been no meaningful dilution at all over the last year, so that's a good thing for sure. Okay, I think we have data enough to move into that final verdict. I have been an avid fan of CNR for a long time, and I do hold it in the 0 to 100K TFSA challenge portfolio. It is one of my go-to defensive stocks. In addition to that, it does have the potential to be a healthy total return stock. I do think this is a great stock for long-term investment, in addition to a very good recession-proof option. Despite the rough year, this is without a doubt a circle the wagon hold forever stock. I do think as the railroads move beyond strikes and labor issues, 2025 could very well be a recovery year that will translate into a nice looking total return. With that being said, they may still have one hurdle though. The proposed 25% tariffs could result in some impact if they remain in place for any length of time. So those tariffs will definitely be something to watch for sure. The income investors may pass on this one, as the dividends are, well, they are pretty small for sure. However, most of those covered call income ETFs with exposure to Canada may just have a little bit of exposure for you. The question I posed at the top of the video was whether this stock is still a great defensive option. I 100% believe it still is. And in fact, when it comes to railroads, this is the better selection in terms of defense stocks for sure. If you are interested in CNR, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on BAM versus BN. Thank you for watching, and I will see you in the next video.